It disappeared with that horrible CPI number. Remember, I've been talking about the base effect and expecting certainly more than 20 basis points of easing. And since we didn't get that, yes, we're going to face a 5% from May of 2021, but I'm less hopeful that even that will matter. What that means is that I think that they're going to have to start to reconsider whether or not 75 basis points is appropriate. Now, we'll hear from Jerome tomorrow, but we know that the more hawkish messages usually come from James Bullard, and I'm anxiously awaiting what he's going to put out in the press. But that's concerning, Scott. You know, I've long said that there are names in tech that will deliver double-digit earnings growth, that have consistent, sustainable demand tethered to secular tailwinds. But if we're looking at 75 basis points, there's better places to find safety, because just the pathology, just the psychology of the tech tape trying to fight an interest rate rise of that magnitude does give me some concern. So I don't see one on the horizon.
Yeah. Everything you said makes perfect sense. But still, I mean, we got pretty oversold. Are you telling me that Thursday off the low and the Friday carryover was it? That this bear market bounce that people were looking for, and some were looking, by the way, for bounces that were fairly substantial through the month, that's it? You don't think we're going to have any more upside, and we're going to go back to thinking about all the fears that we had?
I do. And, you know, I like simple math. And so, you know, when I was talking about the S&P being fair value being somewhere less than 4,000, I was looking at mid-single-digit growth, Scott, which put me at around 215, and an 8 times multiple gave me 38.70. But typically, if we are going to go into a recession back into this year, and I do believe that we will, that is typified by about a 30% decrease in earnings. Now, I'm not there yet, and even though all the big banks keep coming closer to my target, I'm now moving the bar. I'm actually looking for a low single-digit contraction this year. And if we're going to see 195 in earnings at 18 times, that means the S&P is worth about 3,500.
Yeah, I mean, you're not the only one who thinks we could get to numbers like that. Now, albeit, those who agree with you think that we are going to have a bounce before we go down to that level. I mean, even Mike Wilson, who has been more bearish than Mike Wilson, and even he is looking for a, quote, material bear market rally. Now, after that, he thinks that the support level is close to 3,400. Jonathan Krinsky, he thought we were going below 4,000. Did. He talks about 4,200 as a bounce, and then we go back to 3,500. So you guys are not out of the same zip code. It's just you think maybe we get there a little bit differently.
Yeah, and look, if what you're looking for is a bounce, the only thing I can see is that there will be companies that put up really, really strong second quarters. And so that might give us some tailwind, some optimism as we go into that midsummer. Travel and entertainment spending should be strong. We saw that from the credit card companies. If the consumer continues to have a heightened sense of optimism throughout all of this, then yeah, I'm not opposed to saying that we could see some rallies throughout, particularly into those earnings. But the direction is down to me, Scott.
Maybe you're too negative. Maybe you're simply too negative, and you're doing what Marko Kolanovic of J.P. Morgan put a note out today during the halftime program and said that equity markets and people like you are pricing in too much recession risk. He says we estimate U.S. and Euro area equity markets are pricing in a 70% probability of a near-term recession, and you are looking for one in 2022. He says we're also skeptical of the idea that April's equity fund outflow, the highest since March of 2020, is only the beginning of a more protracted phase of outflows. We therefore maintain a pro-risk stance. What if earnings are not going to be as bad, or the sky is not going to fall as far and as hard as you suggest it will?
So there's one other pathway, right? And I'm glad you mentioned the inflows. If Europe enters a really acute recession or a protracted recession, or if energy prices and there's a commodity and energy price are weaponized, we might see flows from other regions of the world into the U.S. for some relative safety. And so that could be a tailwind as well if I was looking to be optimistic. But my long-term view is just based on the data. I don't like to be bearish. I don't necessarily like to be negative, but it's where the data is leading me right now.